strategy: moving qualified funds into your infinite banking policy from a 401k, TSP, IRA, or other retirement qualified fund. This question comes up often, and I've helped several clients with this: how to move retirement funds into a whole life policy. There are many different types of retirement accounts, such as 401k, IRA, TSP, 403b, and others. The commonalities between them all is that they are qualified funds. That is, the money that goes into those accounts are pre-tax. And that means that they are not taxed until the money comes out of the account or is distributed. Then when they do come out, they are taxed. And if you are under 59 and a half years of age, there's also an IRS penalty of 10%. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. Now, if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Often the question takes the form, can I roll my 401k into my whole life policy? Of course, what that means is, can I move my retirement funds into my whole life policy without paying the tax and penalty? Unfortunately, the answer is no. But wait, there is a workaround. You see, money that is paid into a life insurance policy has to be after-tax money, and retirement plans are pre-tax or tax deferred. So money going into a retirement plan doesn't get taxed until it is distributed or withdrawn. A rollover is when a tax deferred or qualified fund is moved from one qualified account to another qualified account. And it doesn't incur any tax or penalties that way. But life insurance is a non-qualified type of an account. So 401k can be rolled over into a qualified annuity or IRA, but it can't be rolled over into a non-qualified account. It can be moved or transferred into a non-qualified account, such as a whole life policy, but it will still carry the tax obligation. However, there is a strategy for making that move without actually losing the money paid to the tax obligation. And that's what this video is going to reveal. Now, here's an example. One client of mine, after retiring, wanted to move all $400,000 that they had in a 403b account. 403b is the same as a 401k, but just for a different type of industry. So the client wanted to move it all into their new infinite banking whole life policy. They had recently lost a chunk of that retirement money due to a downturn in the stock market. And of course, that's what most retirement accounts are invested in. So they wanted to protect what was left. Well, a whole life policy is an excellent place to protect your money and grow it with high compounding interest. So this was a really good plan, but there are limitations to how much can be loaded into a whole life policy at one time based on the size of the policy. The limitation we're most concerned with here is the MEC limit. MEC, M-E-C, stands for Modified Endowment Contract. When you exceed the MEC limit for your particular policy, it'll lose the advantage of the tax-free growth of the cash value. We don't want to exceed the MEC limit, because then we lose the tax advantage of the money growing tax-free. And in this case, the client's policy was a $1 million policy, and the MEC limit was about $100,000 per year. So we could put that much into it, but what about the rest of the at-risk retirement money? Here's how we accomplished the client's goals. First, we set up a qualified immediate annuity that had a 5-year payout. We rolled over the $400,000 out of the retirement account into the qualified annuity. Because it was an immediate annuity, the client was able to take the first payment from the annuity just 30 days after it was issued and load it into the whole life policy cash value. And by setting it up this way, the annuity company can be instructed not to withhold tax from distributions. Each of the following years, the annuity paid out the balance in equal installments without withholding the tax. That way, the client was able to load the money into the whole life policy gradually and not pass the MEC limit. In the meantime, the money in the annuity was earning a guaranteed 3.5% annual interest without risk of loss. The guaranteed or indexed interest paid by annuities varies depending on the type of annuity, the length of the annuity, 5 years, 7 years, or longer, and based on what the Fed dictates. And that variable has fluctuated a lot in the last few years. At the time of this example, 3.5% was a lot better than what savings accounts were paying, but I digress. After each payout of the annuity and putting the money into the whole life policy, the client would then take a policy loan to pay the tax on the money. And the beauty of this strategy is that the money paid for the tax bill was still in the cash account of the whole life policy and earning 6% compounding interest, while the tax bill was at the same time being satisfied. So here's the strategy in review. If the money is in a qualified account that is at risk of loss, we can roll it into a short-term qualified immediate annuity without withholding tax or penalty. The annuity then pays out annual installments also without withholding, which can be loaded into your whole life policy. Then, after the money is in the cash value of your policy and earning the high compounding interest, when it comes time to pay the tax on it, you take a policy loan and pay the tax bill. But your money continues to earn the high compounding interest inside the cash value of your policy. Yes, the tax bill still has to be paid, and there is interest charged on the policy loans. But if your policy is with the right company, the compounding dividend interest paid to your cash value is greater than the simple interest charged for the policy loans. So you are still earning more than you're paying. Essentially, the policy loans are free, and you still come out ahead from the interest that you earn in your policy. And that's a beautiful thing. Additionally, because you are only taking partial distributions each year from the qualified annuity, you only have to pay the tax on the amount that is being distributed. Again, if you found this to be helpful, please like this video, subscribe to this channel. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. Link is in the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is just below here. And if you'd like to apply to become a client of ours, the link to the application is also below. We're here to help. We're looking forward to helping you. For now, aloha and mahalo for watching.